What it do, what it do, what it do. What's up, everybody? Welcome back to the Next Win podcast with your host, Aunt Ma, co-host Justin Vaseur, special lender guest, William Wynn. How'd you like that song? I feel like we need an intro song now every time this pops up.
Yeah, we had to do a dance. I don't dance, but on the side.
You guys look like you can crip walk right now.
We're from LA, chucks, bro.
Look at my chucks, LA man. Style.
With your blue ass.
Actually, I didn't know I was wearing blue.
Yeah, I'm not.
No. We're not mentioning anything. We're done with that.
All right. So, in this episode, where we have a lot of lender discussions here, who's going to help us out with some expertise. We're going to be talking about how much do you need for a down payment. What amount is beneficial, what amount is not, and just everything about down payments. Because everyone always says, I'm trying to save for a house, and they don't even know what they're saving for. They think that they all need 20% down, and you don't. Because William and I have helped someone buy a home for $14,000.
Yeah.
We've also helped someone buy a home with almost no money because there's programs that pay for all of it for them.
Yep.
So we've done it all. And so I guess, William, how much money do you need for a down payment?
Normally.
Well, actually,
holding on.
We got Justin, who's a first-time home buyer. How much do you think you need to buy a first home?
Well, the house that I want is like $600K.
Okay.
$600K.
And I've always been told you need like 20%.
No.
That's what I've been told.
Okay.
Yeah, right?
Okay.
So that brings me to like $100K or something.
20%?
Like 120?
Yeah, 120.
Like 120, yeah. So Asian math right there, dude.
No, that's not Asian math. That's just from doing a lot of transactions on my own where that's exactly the perfect amount. But why does someone tell you need 20%?
That's just what I've been told all the time. Like
you need
from
20%?
My parents. Yeah, from my parents.
But they don't tell you why?
No.
They just say, hey, you need 20% to buy a home?
Yep.
That's false. What is the least?
From friends and everybody.
The least you can do, because I know you have good credit. You're handsome. I'm just playing.
I'm handsome.
18,000, 3%.
On a $600,000 home?
$600,000 home, 3%, $18,000.
That's all you need, $18,000, bro.
Here's the catch, though. You have to pay mortgage insurance. But if you have good credit, it could be like less than $100 a month.
What is mortgage insurance and why do you have to pay it?
Mortgage insurance, because yes, technically you do need 20% down, because the bank wants to have like 80% loan to values. If you have less than that, you have to pay mortgage insurance so that if you default, the bank still makes up that difference.
Okay. So it's on anything lower than 20%?
Correct.
So that was a lot of lender technicalities that he was explaining. To dumb it down for us a little bit, for me as a homeowner, what that means is that if you put less than 20% down, the bank is saying it's a big risk to give you a loan.
Yep.
So I need some more reassurance. So that's what this private mortgage insurance is, a PMI, where if I'm going to lend you a bigger amount of money and you are a risky person, you got to pay me a little extra.
Yep. To insure, like an insurance that.
That's what it means. Mm-hmm. And so that's why your family and friends say you need 20%. So it's weird when people never say why you need the 20%, and I get it, it's because it's to benefit you. But if you don't have 20%, you can still buy a home. And that's what stops a lot of people.
Oh, yeah, for sure.
Because I can tell you right now, almost more than 50% of people buying a home do not have 20%.
Oh, no. No way.
Most people have 3 to 10%.
If that.
You guys hear my dog barking in the background?
Yeah.
Yes. Sorry, we're going to keep rolling here.
Yeah.
3 to 10% is the usual case for all of my clients.
Mm-hmm.
Yeah, I feel like, isn't there like a statistic where it's like 80% of people only have like $1,000 in their bank or something like that?
Really?
Yeah.
I know. There is a statistic. Like, I don't know about 80%.
Yeah, I don't know what it is. That's just a random.
It is high. It is high.
It did take me like 10 years to save $1,000 when I was younger.
So it's high. So, I mean, it's beneficial for both ways. Some people don't mind paying the mortgage insurance because they want to save the extra 15% or 17% to like furnish the home or just have money in the savings account, because if they do the whole amount, now they're kind of like, I don't have any more money in the savings. So.
Yeah, I mean, there's so many reasons. Like everyone's in a different situation, right?
Yep.
Some people are like, well, I don't have good credit, or maybe my credit card's maxed out, or whatever it is, and they can't buy furniture, so they're gonna utilize, saving their down payment for the furniture. Mm-hmm. So it's like kind of like credit card in a sense.
Yeah. Right? So like it just depends on the depends on the situation. I mean, but if you have bad credit, like the mortgage insurance is based on how risky your loan is. So if you have a lower credit score, your mortgage insurance will be a little high. And then
when he says when the loan is risky, he means the person is risky.
The person is more risky. They base it on your FICO score, basically. So that means you're a little bit riskier. So that means you're a higher percentage of defaulting. Not saying you are, but just statistically, you're a higher percent of defaulting.
You fall in the category of people that
won't pay us back.
Yeah,
we're gonna have to send some sharks after. You know what I mean? That's like.
So, but the good thing is, guys, it doesn't stay with you forever. So it will fall off once you have 20% of equity, which means that in today's times, that's very fast. Yeah. Talking about in like maybe 1 to 2 years when value goes up on your home, it'll probably fall off, and you can refinance or automatically fall off, right? But does it take longer to fall off automatically than you doing it manually?
Yes, because it's usually based on when it's automatic, it's based on the original appraisal. So when you bought the house, so when you do refinance, if you know your prices are higher, then you kind of refinance. We can just do it quickly, and then you save money anyways for the interest rate.
Can you just pay for an appraiser without doing a refinance?
I think you can request the bank to do it.
Oh, I see. Cool.
Without doing a refinance. So I would double check though.
That's cool.
Because every bank's different. Every bank's different. So I would double check like what's the general acceptances.
The best case scenario for someone who doesn't have 20% and wants a PMI to fall off fast is maybe putting down 10 to 15%.
Yeah.
You do that, it'll fall off really fast.
Quicker.
You still have some money for furnishing, things like that. So
you get a better rate too.
Huh?
A little bit better rate. So the more down payment, a better rate too.
Yeah, when you do like 3% down, it'll be a long time before that falls off.
Yep.
But
so 3%, don't clarify, 3% is for a very conventional loan. And then there is if you have to do the FHA, first time home buyer, that's 3.5%. So a little bit higher down, but sometimes it's a better rate, but they're a little bit more strict on the housing stuff. So,
yeah. I see. Okay.
So guys, you don't need a lot of money for a down payment to get a home.
Yeah.
Okay. Obviously, the less you put, the more your monthly payments will be.
Yeah, correct.
The more money you put down, the less your monthly payments will be.
Yes.
So, what is the perfect amount that you recommend for a down payment?
I like saying 5 to 10%.
Really? Why?
I mean, 20% to be if you have money, 20% would be perfect.
Yeah.
But if you want to save a little bit, I would say 5 to 10%, because that's a little bit over, the risk barrier. Because you're like 3% is like you're right there, like the maximum. So a little bit over. But I have no problem. And depending on the client, 3% is fine too. There's not a big difference between the 3 to like 15% usually. So, so any amount, but I feel comfortable. Okay, let me rephrase it. I feel comfortable with 3 to 10%. That'd be good. If you want to save.
Okay.
But perfect, 20% down.
So, like William was saying, $14,000, you can buy a house, right?
Yep.
And that's not including closing costs that we're going to talk about in the next episode. So make sure you listen to the next episode about closing costs. But
people forget about that.
You have $14,000 plus closing costs, or if you have a good agent or it's a good time in the market, that can be completely gone.
Yep.
And it's just really $14,000. So, like I said, listen to the next episode for that stuff. But how do you feel now knowing that you don't need 20% down, Justin?
A lot better.
Yeah.
Yeah, because how am I going to save $120,000?
Yeah.
You know what I mean? I could if I really am strict on my spending and all that stuff for the night. Yeah, for a couple of years or something. But, yeah, that's crazy.
Yeah.
Yeah, surprisingly, a lot of our clients, they come to us like that. I'm like, no, dude, like 3%, you're good.
Yeah. And it's, I think back then, most people were like, yeah, I want 20% down because I can't afford $3,000 a month. But I think with the way inflation hit and the way people are getting paid now, like minimum salaries mostly are like $3,000 a month, you know, and most people who buy homes is with their spouse or girlfriend, boyfriends. So it's kind of like double income.
Yep.
So when people see like, okay, I can do 10% down and my payments are like $3,500 a month on a home, we can do that because our income's like $6,000 to $8,000. So the times are different than when our parents bought a home. You know what I mean? Like they're struggling paycheck to paycheck because they're feeding 3 to 4 kids, things like that. You right now, you're by yourself, you know, it's just you and your girl. And like, that's the perfect time. You guys don't have any other expenses besides yourselves.
So much. I envy you. Go to a restaurant, only pay for 2 people.
Yeah. Like yesterday I went to eat Lucille's barbecue at Red Rock. And, you know, we got one dish for the 4 of us. It was a 5-bone beef rib. And then the server's like, that's it? I'm like, yeah, that's it. You know, and it's like, all right, the kids each get their own beef bone rib. My wife gets one, I get one. So that's 4. And there's 1 extra. And I'm like, all right, let's cut up this piece for this kid, cut up this piece for this kid. And I'll just take a little bit and give the rest of the bones to my wife, you know. And I didn't eat any of the sides, let everyone else eat it. And man, times are different when you have a family, you know. Like
I bet.
Like I have money to buy another dish, but it's just like I'm not used to it. I feel like it's not worth it yet. I can still survive off this.
I usually eat the scraps for my family.
The scraps,
I always give them the good food, and then like when you're done, I'll just finish it up. You know,
I kind of
that's what parents do usually. Yeah.
I also use it as an excuse to like that's my diet.
Hit your macros.
Yeah,
don't go around calories.
Yeah, I don't want the carbs. You guys can have all the carbs. My kids need it. So, all right, guys. I hope you enjoyed this episode on down payments and this helped you out, especially Justin. If you guys have any questions or if you got that 14 grand and you want to buy a home, hit us up. And we'll see you on the next episode where we're talking about down payments.
Closing costs.
We just talked about down payments.
Closing costs.
Closing costs.
All right, guys. See you on the next episode.